Good morning and welcome to our webinar today on CHFA Small Business Lending. We have two great speakers today with us, Wyatt Jones and Alex Dempster. Wyatt Jones is a Senior Commercial Lending Officer for the Colorado Housing and Finance Authority, or CHFA. Wyatt's in his 10th year within the Commercial Lending Division of CHFA, concentrating on industrial development bonds, 501c3 tax-exempt bond financing, new markets tax credits, and direct commercial real estate financing. Wyatt received his bachelor's degree from the University of Colorado at Boulder, a Master of Business Administration from the University of Colorado at Denver, and a Master of Science in Finance from the University of Colorado at Denver. Wyatt's also received the designation of Economic Development Finance Professional through the National Development Council. And Alex Dempster is responsible for promoting CHFA's economic development loan products to banking partners, nonprofit organizations, economic developers, and business owners. Mr. Dempster is the lead contact for CHFA's credit enhancement programs, commercial real estate loans, and tax-exempt private activity bond issues. Alex Dempster has an MBA from the University of Denver and a bachelor's degree in economics from the University of Denver, and he's also a certified economic developer, or CECD. We're really excited to have such very experienced and knowledgeable folks today with us. I'm going to go ahead and turn the panel over to Wyatt and Alex, and we'll go ahead and get started.
Thank you, Janet. Once again, CHFA Small Business Lending Tools. My name is Wyatt Jones, and I am here with Alex Dempster as well. And just going to go over kind of an overview of what the Colorado Housing and Finance Authority does in terms of working with small businesses and how we work within economic development throughout Colorado and also in Mesa County and the adjoining counties and areas. Just a quick overview of CHFA, if you're not as familiar of the scope of what the authority focuses on. Really, the Colorado Housing and Finance Authority is focused largely on affordable housing, accessible homes for all Coloradans, and that was really its initial mission back when it was created back in 1973. It's a political subdivision of the state, and so we're quasi-governmental. We're really a nonprofit that focuses on this mission as far as affordable housing. In the early 80s, the legislature gave us the ability to branch out and focus on economic development as well. And so it's really strengthening the state's economy by working on providing financial assistance to businesses and nonprofits in order to grow the state's economy, create jobs, increase services to the people of Colorado. The Community Lending Division, where Alex and I both operate within, really works with lenders throughout the state, predominantly to provide financing resources to help businesses, also work with nonprofits and developers to fulfill CHFA's overall mission on both sides is really how that Community Lending Division works. I mean, here's kind of the overview of what we do in community lending, and it's a mix of some elements that we won't speak to today. I think the easiest way to think of community lending is it does have this multifamily affordable housing piece to it, and then it has the piece that Alex and I work on that a lot of states have a housing authority and then also an industrial development authority, and in Colorado it's really mixed into one, so we really take care of both pieces. But you can see, we have these credit enhancement programs, also direct lending that we do, some conduit transactions, secondary market, CHFA managed funds, and you can see under conduit transactions and CHFA loans that we do have that affordable rental housing item under both of those, because both those fall under those categories as well. But if you look at specifically the business lending tools, this can really serve as kind of our map of what we're going to talk to on the call today. And what I would say is, as we go through this, what we've done is we've dropped in kind of a question slide as we go every once in a while, just so if it's not a clarifying question that as Janet said, that she could break in and get us to clarify a point of the presentation. But also if there's just, we didn't want to get all the way through the presentation and have somebody feel like something earlier had not been addressed. So once again, we'll go through our credit enhancement program specifically, that we manage some funds through the SSBCI program that we'll get into more in depth. And then and credit reserves, and then CHFA loans, talk a little bit about our commercial real estate. go a little bit more in depth on conduit transactions, how we work with manufacturing revenue bonds and 501c3 tax-exempt bonds for nonprofits, both of what we've done regionally within the past few years. Then we want to touch on secondary market, and then we do want to talk a little bit about some of the funds we manage for federal programs, but also some state money that we manage as well. So with that, once again, that's more or less our roadmap of how we're going to approach this. And once again, we do have some slides dropped in for clarifying questions, and we'll start with that. And then Alex is going to start by going over the SSBCI funds, actually two of the programs associated with that, and we'll turn it over to Alex.
Thanks, Wyatt, and thanks again for having us on this call and giving you the overview. I think it's always nice to make sure that the legislators and the elected officials throughout the state know kind of what we do and also how we can help in their communities, because we do, like Wyatt said, in many cases serve as a resource around the state as well. But I'm going to talk specifically about one of the particular programs that we manage for the state of Colorado, and it's called the Cash Collateral Support Program, and I'll just kind of follow this outline I have here. As far as the program overview, you see the term SSBCI, so that stands for State Small Business Credit Initiative. These funds were made available to the state of Colorado through the 2010 Small Business Jobs Act. That was some federal legislation that set aside somewhere in the neighborhood of $1.5 billion for states to use for credit enhancement programs. And so the state of Colorado applied for a portion of those funds. We didn't receive $1.5 billion, but we did receive a sizable amount in the neighborhood of $17 million that was set aside for a program called the Cash Collateral Support, as well as another program I'll talk about in a little bit. But that program is designed, it's designed to help businesses access capital through the traditional banking networks. And this program specifically is designed to help businesses meet the bank's collateral requirements in situations where they just don't have all the collateral that they need to meet the bank's underwriting conditions. So we'll go over a couple of examples in a little bit, or Wyatt will go into those. But the benefits, as you can imagine, there are a number of benefits. So on the lender side of things, lenders like to use this program, and actually we've done quite a few deals in Grand Junction, Mesa County area, and lenders like it because it's very streamlined. Lenders can underwrite a project, underwrite a business loan, and if they run into a collateral shortfall or a situation where they need just something a little bit extra to get the deal done, they can apply to us for up to 25% of their loan amount. So when I say 25%, what we can do is we underwrite the request or their application, and if it's approved, we can deposit up to 25% of their loan amount, make a cash deposit at the bank for the bank to take as additional collateral for the loan that they're making to the small business. So it's kind of if you think about it, it's a backwards way of helping the business get the loan. We're helping the bank meet their requirements so that the business is eligible for that financing. The customer benefits, it's pretty clear. This just is intended to help small businesses access capital. We use it on a lot of real estate transactions where real estate values have changed quite a bit. And we've used it on a lot of new acquisitions, equipment, or even lines of credit for small businesses to help those businesses get the loan that they need to expand and to grow. And then I leave in here economic development benefits, because the question we get a lot of times is why would the state or the federal government set aside money just specifically for this kind of use? And it's just clear in historical examples that this kind of program helps create jobs. It helps create transactions, and it also helps increase the local tax base and that kind of thing, because we're helping these small businesses get the equipment or the line of credit that they need to do more business. So that's the Cash Collateral Support Program. I have another slide here, and I do just think it's nice to go over the structure of this type of deal, because it is a little bit, when we're just talking about it, it's kind of an intangible thing. So it is nice to just know the specifics. As far as eligibility, all small businesses, for the most part, are eligible for the program. Nonprofits are eligible for the program as well. And then lenders, bankers, and community development financial institutions, CDFIs, are eligible lenders under the program. So there's a couple of different levels of eligibility requirements, but basically small businesses and nonprofits, and then lenders that can apply to use the funds on their loans are those banking institutions and CDFIs. The cash collateral, it's as simple as that. When a lender applies for cash from us, we're opening a bank account at that bank and we're wiring funds into that bank. If they need $100,000 to make the deal work and it meets all of our requirements, we're just wiring $100,000 and letting them take that as additional collateral. The terms of our deposits. So a lot of times we get asked, how do we get our money back? The client, the business, is the end client here, and they're not repaying us. As long as they repay their loan, once that loan is paid down to a certain level, then it meets the bank's underwriting criteria and their loan-to-value criteria. And when that happens, we just ask that bank to release our cash deposit back to us so that we can use it to support another business. So that's kind of the life cycle of this program. But the term of our deposit, it ranges. Generally, we're doing 3-year deposits, but we can do anything from 1 year up to 10 years. And then fees, we've made it real simple, so the client just pays a one-time fee to use the program up front, and then we deposit the cash as long as the bank needs it to make that transaction work.
This is one of the primary SSBCI programs that we've rolled out to the state and really to businesses and lenders, and so we always think it's important to really stress this program a little bit more because it's really a great way to leverage a little bit of money to make a lot of loans and really work with the banking partners around the regions that around Colorado to get them many times to be able to do the loans that they want to be able to do, but they're for the lack of collateral maybe that they have, or maybe in the case of just needing additional equity in, it is almost a but-for. If not for this program, the loan doesn't get done. And so doing a couple examples, I think, really clarifies how this works outside of just the background on the program and general structuring. But if you look at a cash collateral example, a manufacturer who produces kitchen equipment, they want to refinance their $1 million piece of equipment. And the reason why, from an economic development standpoint, we like that is that if they can get that lower rate, maybe even re-amortize their loan, it just gives them more cash flow in order to operate their business, hire more people, all those important things in economic development. In this case, the building was valued at $1.2 million. The bank's limits were at 75% loan to value on real estate, which ultimately they weren't there on the valuation, so I think they were at about 85%. And so the bank needed the borrower to put more money in order to refinance their property and get the more beneficial terms. And so, from a visual standpoint, through this program, CHAFA was able to provide a $130,000 cash deposit, which was held at the bank that secured this loan. And you can see here, the value is 1.2. The bank lent 75% bank margin, so $900,000 on that. And then, but if you look at the cash value being put into the bank in this case would lend 100% on the cash because it's dollar for dollar, and it got them to a $1,030,000 loan, which covered some of their extra closing costs, things like that. And so by putting just $130,000 cash, once again, we don't get it paid back, but the thought is on a good loan. This doesn't make a bad loan good. It just makes a loan that, from a credit perspective, the lender is already very comfortable with, and when it gets paid off, the $130,000 cash will come back into the program, and you'll do it all over again. Example number 2, service business, a mechanic. They were going to buy $400,000 worth of equipment. The business owner had $60,000 that they'd saved up for a down payment, but once again, the bank's limits were 75% loan to value on equipment, and this would have been an 85% loan to value on equipment just with the borrower's amount to put in. The borrower the extra cash they did have to put in, really they wanted to save for working capital and general business operations. And so, very similar model, 75% related, ended up with a $300,000 loan from the bank, cash deposit of $40,000. The bank could lend 100% on that. and they wound up with a $340,000 loan. So the $40,000 loan was able to, or $40,000 cash deposit was able to increase the amount the bank was able to lend and get them where they needed to be.
And this is Alex again. So just to recap, or not necessarily recap, but just to wrap up the cash collateral support section. So the application, I mentioned this earlier, but it's designed so the lender really underwrites the project on the front end, and then if they find that there's a collateral shortfall or there's a need to use the program to make or to help the lender get approval through the bank, then they apply to us to use the cash collateral support. So as you're out in the community, if you're speaking to bankers and that type of thing, we're always excited for new bankers to call us and inquire about the program, because we think the more help we can get the more help we have to get the word out, the more beneficial this program is to the state and the businesses within the state. So as far as timing, it's very streamlined. It generally takes us about a couple of days to review an application and make a credit decision. And then all we're doing is we're opening a bank account and wiring funds. So this program is designed to fit well within the typical time it takes for a bank to close a business loan. So it works well that way. And then access to funds, we have a big portion of that $17.2 million I mentioned earlier in a bank account here. So we do have the access to the funds, so we're able to close these deals pretty quickly. And then ongoing, it's designed to have very minimal reporting and be very easy for the lenders to use, not only on the front end, but also with the reporting requirements. We designed it so that it doesn't take a full-time employee at the bank to manage these types of programs. And to complete our reports, it really takes about 10 minutes per deal per year to fill out a report. So that's a nice perk as well. So I think with that, we're just going to stop here and open it up to any questions before we move on to the next section.
Okay, great. Does anyone have a question on this section? Go ahead and you can put it in right now if you'd like to. Okay, looks like one came in. Are most local lenders aware of CHFA's cash collateral support program, or is this something businesses must know about and ask for?
Well, I like that question because there's not a simple answer to that, but we help, actually the IBC, the Independent Bankers of Colorado, and the Colorado Bankers Association, they helped us create this program last year. It was introduced last year. And so they also help us kind of market the program to the lenders and make the lenders aware. But it's like anything, if we're not in front of the lenders constantly, sometimes they forget about the program. So even if bankers might have heard about this last year, they might forget that it's a tool available for them to use this year. So I think that constant education and that constant reminder is always helpful. The other piece of that question was the businesses. We've found that a lot of lenders have found out about this. A lot of individual bankers have found out about this program through business owners coming into the bank and handing them a flyer and saying, you know what, this is something I'd like you to look into. And so that helps as well. But yeah, kind of on a general scale, there's pretty wide participation throughout the state through the banking sector. And so we feel like the banks, for the most part, know about the program. But it is important to continually remind them that this tool exists.
So it sounds like it's also something important for our economic development professionals and also local government folks to be aware of as well, and make sure the businesses coming to them are aware of that.
And I was going to say, I mean, it is a constant trying to make lenders, because there can be turnover at banks and having them be aware of the program. And some of it is, if a bank has already invested in an SBA program, that they may have that comfort level with that. But there are some big differences, I think, just as far as streamlining and process with this program. And it's unique and does some things that the SBA programs won't do. And so, this is kind of, these type of calls and engagements with people in the community and lenders is kind of part of what we're doing to try to make sure we're covering the entire state, which lender approach you're just trying to hit as many people as you can, really.
Great, thanks. I don't see any other questions that have come in, so if you guys want to go on to the next session, that'd be great, or section.
Oh yeah, you bet. So the next section, we're going to talk about continuing this credit enhancement. So this isn't a CHFA loan. This is a resource we're providing to lenders to help the lenders make loans and help those businesses access capital. But this next one is called a credit reserve. So it differs a little bit from the cash collateral program. Credit reserves are designed with an insurance concept in mind. So lenders sign up on the front end to participate in the program. And we have about 19 or 20 banks across the state that participate in our credit reserve programs. And the lender has a lot of discretion under these. There's no CHFA underwriting. The lender is required to follow our guidelines, but the lender can make a loan and enroll it into the program. And each loan that lender enrolls into the program, CHFA deposits a small amount, generally somewhere in the neighborhood of 2 to 5% of that loan amount, in a reserve account held by the bank. So the bank, because it's an insurance concept, the bank can enroll multiple loans, and that's what we typically see from lenders that are participating in this program. They enroll multiple loans, somewhere in the neighborhood of 10 to 20 to 30 loans over the life of the program, and each one of those loans receives that kind of small little premium from us deposited into a reserve account. And if any of those loans ends up in a workout situation, that lender has this externally funded reserve built up to help the bank offset losses. So it reduces the bank's risk. It helps the bank make loans that they might not otherwise make, and we'll go into this a little bit more. But it just helps that banker provide credit to businesses that, again, are credit-worthy businesses, but without this program might have been overlooked or might not have been given the amount of time or review that they deserve. So anyhow, that's the basic credit reserve description. It's an insurance program to help the lenders mitigate their small business lending risk. The benefits to the lender are pretty clear. It reduces their risk, allows them to take a look at deals that they might not otherwise look at, and overall helps them protect the customer deposits that they're lending out. And then the customer benefits. So the customer here, again, it's a small business owner. So the benefits here are that since there are lenders around the state participating in the program, if a business doesn't have a banking relationship or has a banking relationship with a bank that just will not provide a loan to them, there's this list available that they can just contact banks in their area and connect with lenders that are using this program to make small business loans. So we really see that benefit as kind of twofold. One, connecting the business with the lenders using the program, and then the second part of that is helping those businesses access capital. And then the economic development benefits. We really like these credit reserve programs because they leverage a small amount of public resources with a large amount of private capital. So when I say what I mean by that is that the history of these credit reserve programs over the past 3 years, I believe we've used about maybe we've deposited $1.2 million at banks around the state, but that's leveraged close to $30 million in lending. So it's just a terrific leverage ratio. I might have the numbers mixed up a little bit, but it's just a terrific leverage ratio. For every dollar we're depositing at a bank, it's helping businesses access 20 times that amount in private sector lending.
And I just had a question come in that I think can help clarify.
As far as how...
I'm sorry, can you guys hear me?
Oh, yeah, you bet.
Okay.
Oh, yeah, go ahead.
I just had a question come in that I think might clarify future questions or conversations here. Are these tools for organizations to leverage, quote, municipal benefits but aren't actual cities, or how does this benefit a city or county?
The cities and counties specifically, how do they benefit?
Well, I think it's more clarification about is the tool you're talking about for an organization to leverage municipal benefits when they aren't actually a municipality? And if not, how does this benefit the municipality or the county? Does that make sense?
Yeah, a little bit. Well, let me try and answer that, and you can
Okay.
tell me if I got it. So these programs, these are statewide. We have statewide jurisdiction, and we operate around the state. So these tools for the county and for the city and the municipality, this tool, it's good to be it's good to be aware of these tools, because you can have your bankers sign up and use them and help the small businesses in the communities access capital.
I mean, is it the thought that you could use this in conjunction or to enhance a municipal program?
That's kind of what I'm assuming by the question. That's what it sounds like to me.
Okay. I mean, really, these programs that we manage, they're tied. I mean, some of them, like the Cash Collateral Support Program and the Capital Access Program, we're guided a lot of the times by U.S. Treasury, where the money came from, and so you can use it for lenders, meaning like a bank lender as opposed to a credit union, and CDFIs, which is the U.S. Treasury designation. So thinking about like the revolving loan fund at the Grand Junction Incubator, you couldn't use it for that program just because it's not. I don't believe they're a CDFI and they're not a bank lender. But where we do see working with revolving loan funds is that you would end up having a local lender doing a portion of the total lending need, where maybe they say, okay, well, this project needs $200,000. We'll do $100,000, but we want this cash collateral in there, and then they'll partner with the local revolving loan fund to provide the rest of the gap financing. So okay. I mean, I think that's where you see it work more than these programs actually being able to enhance a specific program.
Okay, so the city's role is more of a connector with businesses and economic development professionals with the banks, just to make sure they're aware of it. But there really then is no risk for the cities or counties to take on, no repayment or default or anything like that?
No,
okay.
No, they're not. These are all funded either federally or through the state legislature.
Okay, thanks.
So this is this slide here that you're looking at, how CCA helps businesses. Again, this might be a little bit of I might be repeating a little bit, but lenders can use the program for smaller credits. So sometimes those loan applications that might not seem like worth the bank's time, they can build a program around these credit enhancements to make sure that the bank's providing capital to those business requests, but also mitigating its risk quite a bit. The participating lenders list really connects businesses with those lenders that are using the program. And then we at CHAFA promote this program at every event we go to. So we hand out these lists to small businesses around the state to help them connect with those bankers using the program as well. And then the final slide on the credit reserve programs is specific to this Colorado Capital Access. So Colorado Capital Access is a type of credit reserve. It just has this name, Colorado Capital Access, and it's funded through the SSBCI program, which I mentioned earlier. And as far as the process, so lenders need to become participating lenders. So if you have lenders in your community that are interested, they can just contact us directly, and we'll go through that review process with them. But once they're a participating lender, they can just begin enrolling loans as long as they follow the program guidelines. So enrolling loans is real simple and streamlined. It's basically filling out a form and faxing it to CHAFA. And then that's what we need in order to make that 2 or 3 or 4% deposit into that lender's reserve account. Again, access to funds, it's immediate and it's well funded, and we're actively seeking lenders to participate with as well. And then also, again, the reporting is very simple. We design this in conjunction with the CBA and the IBC, the bankers associations, and we have it set up so that annual reporting probably takes, again, maybe 10, 20 minutes per year. So it's just real simple and doesn't take a whole lot of time. So I think with that, I do have another pause here for questions, if there are any that came up. If
Okay.
not, we can move on to the next section.
And I would say with questions too, I mean, I know that it's kind of a lot of information, and if people have questions after the fact, obviously you can send them to Janet, and she can forward them to us, or you can refer them directly to us to talk more about it. I know, once again, this is trying to provide just an overview of the things we do so you can just be familiar with it. And I think we always look at it as kind of the first step. So if you hear about a project that, we listened to this phone call at one point, and I think this maybe fit into us. The one thing is I think we're very accessible as far as trying to just contacting us, and we're more than happy to talk to anybody in your communities about the programs we do.
Great.
I'm going to go over our conduit bond programs, and really our role is as a tax-exempt bond issuer, and obviously a municipality or a county can end up being an issuer as well. And the reason why we end up being involved in these transactions, really two reasons. One is either the project is large enough that it needs additional allocation, and so they come to us, and rather than to the municipality asks us to be involved, or maybe the local issuer doesn't have the same process, or doesn't have a process in place to put one of these transactions together. So they'll ask us to be the issuer, and then sometimes we just have projects that approach us directly. But we generally try to reach out to the community to talk to them so they know that we're involved in the issuance. I'm going to go over nonprofit 501c3 bonds and also manufacturing revenue bonds, and they have a lot of similar components to them, basically how they work, but I'm going to keep it fairly high level and just kind of talk through how it works and how it can be used. Nonprofit 501c3 bonds are kind of what they sound like. It's a community development tool. And so there's job creation, job retention, just in the respect that, oftentimes there's some construction jobs, but also, generally a 501c3 is buying a building, they're expanding and doing new services. There's some capital investment as far as community revitalization and also the social benefits. I mean, as far as really the idea with these tax-exempt bonds, the easiest way to think about them is that oftentimes, since the investor in the bond gets a tax-exempt rate, doesn't have to pay taxes on the interest they earn, excuse me, that they can offer a lower rate to the ultimate borrower. And so from a 501c3 standpoint, that just helps them as far as that they spend less money on their facilities and put more money into their programs that help the local community. Most recent bond deal that we've done for 501c3 in Mesa County was Mesa Developmental Services, which was a 501c3 bond issue, I think, with Wells Fargo being the investor in those bonds. Industrial development bonds, I mean, you'll hear these referred to as IDBs and MRBs and all these other things, but really if you hear industrial development bonds, manufacturing revenue bonds, it's really the same thing. It's an economic development tool, business attraction and retention, job creation, job retention, capital investment, and the way either economic development professionals or municipalities use this typically is offering up that you have allocation available. Now, there's been a lot of allocation available, I think, nationally, but the sale concept of this has been that you have a process in place to get it done efficiently, and I think that has actually gone a long way to get these people interested in using this type of project and maybe moving to a local area that is more attractive. A good example regionally has been within the past few years when PAMA built their new facility that I know we were involved as far as providing allocation or cap for their new manufacturing plant in Grand Junction. Really targeted projects it's manufacturers, businesses that assemble, fabricate, manufacture, have a manufacturing process. You can't be a software developer. It has to be a tangible manufacturing. It really is just changing, bringing in raw materials and changing it or doing a value add of some kind. And the purpose of the fund is, purpose of these funds can be, the acquisition of land, a percentage, new construction, machinery, furnishings, some soft costs. Typically, you can't go into a building that's a brand new building and you don't have to change it and you just want to buy this existing structure. It really is to to affect change within a community while helping the manufacturer as well. And the advantages of the industrial development bonds, it's tax-exempt interest, the ability for manufacturers to receive below market rate financing. And really, its targets manufacturers. Just, I mean, the economic developers on the line will realize that it's primary jobs, and it's just trying to get these type of entities support as far as getting the lower interest rate that they can invest in job creation. And there is a benefit derived by the local community, is the fact that you're creating jobs and growing business locally with manufacturers. And I put together this slide called "How IDBs Work," and it's kind of has graphics that move, so we'll see how well it transitions on this program. And really, this is how 501c3 tax-exempt bonds work. Ultimately, you have the state provides private activity bond allocation, in this case to CHFA. Then you end up having an investor or a bank that maybe has a borrower. This is really a bank-held transaction, so you don't have to worry in this, in this model as far as the part where you're going out to market and those things. But this is typically what you see now is you'll have this bank entity that has a borrower that they're interested in working with, or the borrower has found an investor or a bank that wants to work with them. And CHFA ends up issuing the bonds, and in this case, you end up having the bank end up basically investing in those bonds and saying, okay, well, normally this is the spread we want on these type of loans, but we're willing to, because our interest receive is tax exempt, we'll offer a lower interest rate and make the same spread. And so it benefits the borrower in that way, that the bank gets exactly the same spread that they would expect on their interest rate, but the borrower gets a lower interest rate. So then the proceeds of that bond sale basically gets lent to the borrower. But at the end of the day, CHFA really assigns all their rights. It's a conduit deal. We don't have risk of repayment on the bonds. We don't have this legal risk with repayment to the bondholder. So you end up having a borrower that's just paying the investor back directly, or oftentimes the lender. And just a quick overview, I mean, these are really, they're supposed to be small, but they look at a small business. So you're looking at projects that are $10 million, tax-exempt bonds of $10 million and under. It doesn't mean that you can't do a larger project. It just means that once you get over $10 million, you do more of a taxable bond issue. So you can really only realize the benefit up to $10 million. And there's some guidelines as far as capital expenditures that, once you get into a project, you look at and kind of not to exceed limits. Projects less than $2 million and $2.5 million are difficult unless they're really under a specialized program. We actually have a program that targets $2 million and under and really streamlines a lot and gets reduced costs for bond counsel. So you can look at those smaller projects, and the reason why we set up a separate program to do that was to look at smaller communities that maybe had the $1 million project for a manufacturer, but it wasn't cost effective to do a regular tax exempt bond deal. But as I said earlier, if people on the phone listening have questions and say, I may have a prospect or just need me to provide additional information, once again, more than happy to follow up on that. I didn't know if there were any specific questions on that. Once again, a lot of information. Okay, we'll continue.
And we just have a couple more sections here of economic development resources for financing. And CHFA we also do a lot of direct commercial real estate lending throughout the state. We're targeting a lot of rural areas throughout the state of Colorado, but we do also have programs available for Mesa County and Grand Junction. And actually, over the past couple of years, we've done a few deals over in Grand Junction too. So the programs that these probably sound very familiar to you are SBA 504 and the USDA Rural Guarantee programs. And these are designed to provide permanent financing. So when we're brought in to work on a project, a commercial real estate project, it's always going to be an owner-occupied, a business that occupies at least 51% of the space. That business or the owners of that business will be buying the real estate. And and we're providing the long-term financing. So in cases where a business might be constructing a new building or acquiring an existing building and then providing or doing upgrades to that building or improvements to the building, we're relying on a local lender to provide that short-term financing and manage that construction piece and that acquisition piece of the project. But once everything is complete, that's where we'll come in and pay off the local lender and provide long-term fixed-rate financing to the client. So our terms are, all of our loans are 20-year fixed-rate loans, and so they really appeal to those businesses that are concerned about fluctuating interest rates and businesses that just want to stabilize their occupancy expense over the long term. The lender benefits here, we're partnering with local lenders. Probably 99% of the commercial real estate transactions we work on are brought to us by local lender partners that are doing the construction financing or the acquisition financing, and they're just looking for an organization like us to come in and pay off their loan once that short-term financing is complete or is due. The customer benefits, again, long-term fixed rate. It's entirely rate-driven and also entirely equity-driven. So we're generally looking at providing about 85 to 90% of the cost of the building and the improvements. And so what that does is it helps that small business or that business owner preserve a lot of their capital for operations and their own business uses rather than tying up a lot of their capital into the facility itself. And then the economic development benefits. We see this as a kind of a wealth creator in communities, helping the small business become stable, and buying real estate really does help them over the long period fix their occupancy costs and reinvest in their community. The other program along these direct loans that we provide is when local lenders in the area originate government guaranteed loans. So it's kind of a long list here, 3 different types of government guaranteed loans, but CHAFA will invest in those. So we'll partner with the bank and buy the guaranteed portion of those loans from the bank. And those are very good investments for us to invest our money in, but they also help the business owners and the farmers in these areas access long-term fixed-rate financing for the same reasons as those small businesses that I just mentioned would. They may just be concerned about the interest rate environment, and they may want to lock in their interest rate for long-term. So there's lender benefits there by we provide kind of more options for the lenders to provide to their clients, and then the customer benefits is that long-term fixed-rate financing. And then again, the economic development benefit is just providing that steady and predictable occupancy expense or interest rate expense for the life of the loan. And here I'll turn it over to Wyatt.
And really briefly, I'm just going to go over some of our managed funds because, as we mentioned, as with the SSBCI funds, CHAFA really, one thing that we've got a good handle on is working on new programs and as far as administering programs and kind of the back office piece to it. So we work in that capacity with several revolving loan funds and also on new markets tax credits. We administer the statewide Colorado Energy Office Loan Fund, also the Brownfields Revolving Loan Fund, which really is with the Department of Health and through EPA as well, that we work with them as far as helping to do remediation of contaminated sites. Really, I mean, you can even just programs on remediation on kind of the concept behind that is you may even just have the local gas station which is no longer functional, and it would be great if somebody else could take it over and build something on that corner, but it has leaky underground storage tanks. That fund will come in at a low rate and be able to provide the funding to actually help with the cleanup on that site. And we also manage the Historic Revolving Loan Fund, which is through the Colorado Historical Society, and manage that fund, and that's really for improvements to historic properties. And then lastly, we do have a community development entity called the Colorado Growth and Revitalization Fund, which administers New Markets tax credits. And I don't spend as much time on this right now just because there hasn't been a lot of activity as far as the state receiving allocation for New Markets tax credits, but that is a program that we have a lot of involvement in. And obviously the economic development benefits of these programs, it really goes back to in all these cases that you're oftentimes pulling in federal funds into Colorado, and you see that as well with things like the industrial development bonds, that you have projects oftentimes in areas like maybe Walden, Colorado, which are much smaller communities, and doing a manufacturing plant up there that is pulling in an investor from Chicago to do a project that is really benefiting the area. So as far as those managed funds, while we don't directly provide the financing for it, we've got a lot of experience structuring those. And I would say, if you, once again, any questions on those individual programs, you can let me know. Any questions?
I did get one that came in, and it was under, is this your last section, or is there another section?
Oh, I think that's generally my last
okay.
section. I think we have just something to touch on, but what is the question?
Well, it came in on the credit reserve section, I believe, when you were talking about there's 19 to 20 banks across the state, and there's a list of those banks. Where could we find a list of those banks is the question.
It's on CHAFA's website. There's actually a list under there's a section that says for business owners or for lenders.
Okay, great, thank you.
And there's a section on the Colorado Credit Reserve and Colorado just the credit reserve programs.
Great, thanks.
And actually has a list of the participating lenders.
And while we've had some folks have asked questions throughout, in particular about whether or not we'll have the PowerPoint available, and we will. As the PowerPoint itself, I can send that out to you probably today. And then we're recording this, and it should be available next week. Usually it takes us about a week to edit it, convert it, and get it online. Next week is finals week, so it might take us a little bit longer than that. But as soon as this is posted online, I will send an email out to everyone who is registered and let you know where to click to be able to view that at any time on demand. But we do still, yes.
I was going to say really quickly, we had a couple other things we were going to show just before you wrap up, if that's okay.
Oh, yeah, and I just wanted to also let folks know, if you want to ask a question, I've seen some of the digital hands raised, but not a question necessarily attached to that. So if you look under the section called question and click on that, it'll bring a drop-down box, and you can type in your question there. You can also do that in the section marked chat. It'll pull a drop-down box, and you can enter your question there. And you can do that right now while Wyatt goes to the next section.
Thank you. And this is Alex again. I just wanted to, no, that's okay. The last couple of slides here are just to show you how you can stay connected with CHAFA and stay up to date on what we're up to. But I did want to point out that we're basically doing this exact same webinar next week. We target lenders like we mentioned. So if anybody is interested, or if anybody wants a copy of this flyer and to forward it to your lenders in your community, or if you have people at your organization that might want to hear about the financing tools that are available through CHAFA, it's a good opportunity for that. And it's going to be next Wednesday. And so what I'll do is I'll just distribute the flyer to you, and you can distribute it to everybody else if that works. Or you can email us directly, however.
That's great. I'll make sure everybody gets that. Thanks.
And then the next is the Federal Reserve Bank of Kansas City, in conjunction with the FDIC and the Office of the Comptroller of the Currency. They're hosting a lender summit next month. It's June, I believe it's June 13th. Actually, this should say, yep, June 13th. It's an all-day summit. And so I also, another flyer available to the lenders in the community. We encourage those lenders to come and hear about all of the credit enhancements and economic development lending tools that are available for their use throughout Colorado. And again, I can send this to you. And then the last item is CHAFA's 2013 Housing Credit Summit. And I know we did not talk about affordable housing or low-income housing tax credit financing today, but this summit is also on June 13th. And I encourage any of you that are interested to attend. It gives you a great overview of how to use low-income housing tax credits in your community, what makes your community more or less competitive, because these can be pretty competitive resources since they're very limited throughout the state. So that's another item that's coming up. And this particular item you can register on CHAFA's website as well. Some other ways to stay connected with CHAFA is through our e-news, and that's our website, chafainfo.com. You can sign up for specific information and updates in these different areas that the CHAFA functions in. We do webinars, and you're welcome to participate in any of our webinars or sign up for any of our webinars. You can send either me or Wyatt an email to sign up for those. When we don't have scheduled webinars, you can still just have us notify you when the next one is, if it's something that you'd like to put on your calendar. We also do Facebook, Twitter, and YouTube to stay connected, and here's all of our contact information. So thank you all for joining today.
Great, and thanks for a really thorough presentation. I learned a lot. I was a commissioner for 8 years and even on the board of our economic development entity here in Mesa County for several years, and I still learned some new stuff today, so thank you very much for that. We will give folks a few more minutes to submit a question. Again, just click on the question box. It'll drop down and you can put your question in. And while we give you time to do that, I want to remind everyone that we have 2 more webinars in our Economic Development Webinars series. The next one is May 22nd at 11 a.m. and that's about the Governor's Blueprint, Governor Hickenlooper's Bottom-Up Economic Development Plan. And we'll have Carrie Linker, the Director of Regional Development for the Colorado Office of Economic Development and International Trade, will be our presenter for that one. And our last webinar in this series will be One Size Doesn't Fit All, and that'll be June 12th at 11 a.m. And our presenter will be Tom Kern, who's the CEO of the Steamboat Springs Chamber Resort Association. So if you go to our website, coloradomesa.edu/local government, you can find out how to sign up for those webinars. I don't see any more questions, so you guys must have done a fabulous job of answering everyone's questions.
I mean, once again, if people have questions, they can contact us, and sometimes it's just you need some time to process a little bit. So if by all means, give us a call if you have questions.
Great. Thanks to both of you, and thanks to everyone for listening.